It is Thursday, December the 9th, as we head into the Christmas season.
Happy holidays. Yep. 2 days ago was December the 7th, and for all our clients that are veterans in World War II, Pearl Harbor Day. Again, thanks for all that you did during that period of time for this country. So,
Well, the volume of calls from our clients has increased, especially in the area of Roth conversions. What is a Roth conversion, and how can a Roth conversion help you, even if you're in your 60s or 70s?
A Roth conversion is taking your IRA that is, again, as you know me, I talk in terms of buckets. It's a bucket of pre-tax money. None of that money in there has been taxed, and when you take it out, you pay tax on it, and if you hit 72, you got to start taking it out. So taking that bucket of pre-tax money and changing it over into a bucket called a Roth. And in that Roth, if you hold the Roth for 5 years, everything inside that bucket, including all earnings going forward, is a tax-free investment. Now, the conversion, the changing of it, is a taxable event.
It is, and there's some magic numbers. Magic numbers being from 23,000, if your adjusted gross income is between 23,550 to 83,550, you have a tax bracket of 12%. Anything above 83,551 and above jumps to 22%. So if you're doing a Roth conversion, you keep it below 83,550, you're dealing with a much smaller tax bracket.
Now, what has made Roth conversions the talk of the town, and why we've gotten so many phone calls, inside the legislation that is titled the BBB,
Build Back Better,
something out of Washington. Inside of that, I referred to it yesterday with a client who got a chuckle out of it. Maybe you will too. Inside all that gobbledygook, that's a new economic term we're using, gobbledygook. There is language in there about the removal of Roth conversions. So we did some research, and here's the research that we bring to you. The Roth conversion is going to be removed if the bill is passed on after-tax money that is in IRAs or 401ks that become IRAs. Now, I'm way up to here in the weeds. Inside your IRA, if you have after-tax money that you already paid tax on it, or if you have it in your 401k that you then are going to change into an IRA, and keep it in there, that piece of it is, if the bill is passed, is no longer 100%. It's period. Conversions are not allowed on that piece. However, conversions in the BBB plan are still allowed, except there's now language potentially that says that if you have adjusted gross income of $450,000 or more.
I think it's 400.
Okay,
400 even.
You might not be able to do then the conversion. And that is an if, unknown yet, but that's being bannered around.
Yeah.
So right now there is a swirl out there that the Roth conversion is going away. That's not true. It is still allowable, except in the BBB legislation for after-tax money. We quite frankly don't see anybody in that scenario. And then if the income limits come in, then potentially is there. But now is there a lot of activity. In fact, we met with a client yesterday and did a conversion on it. Yep. So if you have an interest before the end of the year to go to the numbers in which Gibb is talking about and do a conversion, you need to call us. We found out yesterday, we can do it 3 different ways. We can convert it in kind, which means we literally can pick it up as it is, move it over
into the Roth.
We can liquidate inside the IRA all the holdings, no tax, move all the cash over and start over again in the Roth, or we can liquidate some of the pieces, in kind the other pieces, and bring the cash over and do it that way. 3 different ways.
Keeping in mind, I think that the magic numbers that especially your CPA is going to be working with you on is that $83,550 of adjusted gross income. Because as the tax brackets go up, it gets harder and harder for it to benefit you, except if your goal at the end is for your kids to get the money as tax-free as possible, then the more you convert into the Roth, the more likely it's not going to hurt their tax brackets when they begin to take the money out of now the Roth, which doesn't have the issues of
the beneficiary IRAs.
That's correct.
And all those complicated issues.
So they're basically taking that money out tax-free because you've elected to go ahead and pay the taxes now. So from an estate planning standpoint, if that is your ultimate goal, then it works very well regardless of the tax bracket.
All right, a lot of discussion, a lot of phone calls this week. Hope this helps you understand it. If you have any questions, give us a phone call. This has been a good week, 3 straight days of being up, a little down this morning, but we still see the end of the year being up. Always remember, it is your money.
And your money matters.
Happy holidays.